56% of Americans held less than $1,000 in savings in 2019. Not the poorest Americans, all Americans. The majority of the wealthiest nation in human history was one car repair away from financial collapse, while sitting on a stock market worth $30 trillion. That gap is not a failure of discipline. It is not a failure of income. It is something far older and far stranger. It is the gap between two survival instincts that evolution built into the same brain and that most people never learn to resolve. For 12,000 years, humans stored surplus to survive. Then they discovered that storage alone slowly kills you. The Neolithic farmers of the Levant buried grain in sealed pits before they built walls. The merchants of ancient Babylon lent silver at interest before there was a word for interest. The Medici of Florence moved wealth across a continent without moving a single coin, because the coin was too slow, too heavy, too exposed. Each of them arrived at the same arithmetic through loss, not theory. A resource held still decays. Only a resource in motion survives. This is not financial advice. This is 12,000 years of evidence. And the path from saving to investing, the real path, the only built on history, not a podcast, has exactly 3 steps. All 3 were discovered before the Roman Empire existed. Before investing existed, there was storage. And storage had a fatal flaw that no one talks about. Archaeologists excavating settlements dating to 10,000 BCE along the Jordan Valley and the upper Euphrates have found them. Sealed underground chambers, carved into bedrock, packed with grain and dried legumes and pressed oil. The oldest form of financial planning the species ever attempted. But the grain rotted. The oil grew rancid. The pit attracted vermin. A sealed chamber could protect a surplus for 1 winter, perhaps 2, not indefinitely. Here is the number that explains the last 50 years of American financial behavior. The U.S. personal savings rate peaked at 17% in the mid-1970s, then and fell to under 3% by 2005. Bureau of Economic Analysis data. That collapse happened not because Americans became reckless, but because millions of ordinary households made a rational calculation. Saving in cash was visibly losing. The jar was leaking and they could feel it. The move from saving to investing is not primarily a financial decision. It is a psychological one. And the psychology is ancient. The human brain was shaped in an environment where a resource consumed today was certain, and a resource deferred to tomorrow was exposed to predators, weather, and theft. Hold the grain. Keep the cash close. Trust what you can touch. This is why handing money to a stranger, or a market, feels like danger even when the math says otherwise. The brokerage account is a promise written in pixels. The grain pit was carved in stone. And yet, 4,000 years ago, Mesopotamian merchants solved this exact problem. They called the structure the tadmiktum, a pooled investment contract documented in cuneiform trade records from Kultepe in modern Turkey, dating to around 1900 BCE. Multiple merchants contributed silver or goods to a joint caravan venture. Profits split on return. Losses split if the caravan didn't come back. That structure, spread your exposure across enough ventures that no single failure destroys you, is what a 20th century economist would later formalize as diversification. The Mesopotamians invented it because the alternative was extinction. The pattern migrated. The Roman societas pooled capital for trading, venture es without joint liability for debt. Medieval Islamic merchants developed the mudaraba, a contract where one party provided capital, another provided expertise, profits split, investor losses capped at the original stake. The Medici Bank created bills of exchange that moved wealth from Florence to Bruges without silver crossing the Alps, where it would be robbed. In 1602, the Dutch East India Company issued the world's first publicly traded shares. The innovation was not the ship, not the Spiss route, not the profit margin. The innovation was this. For the first time in history, any citizen of Amsterdam, a baker, a textile worker, a school teacher, could buy a fractional stake in a global trading empire for a modest sum. The Amsterdam Stock Exchange opened the same year. Share prices rose and fell with news from the East Indies. A fleet returned, a storm sank 3 ships, a war with Portugal cut the route. The investors who held through the volatility are rewarded. The ones who sold in panic locked in a loss. The step from saving to investing happens historically and individually when 3 things converge. First, surplus, more than immediate survival requires. Second, a trustworthy structure, a contract, a market, an institution with rules. Third, the lived experience of watching still money lose value. When those 3 conditions meet, the grain goes into motion. It always has. The Sumerian temple charged interest because grain in a pit trots. The Florentine banker invented the bill of exchange because a silver on a mountain road disappears. The Dutch merchant bought company shares because a single ship sinking could not be survived alone, but a fleet could. None of them thought they were building modern finance. They were trying not to lose everything. The system built itself out of that pressure, one failure at a time. The jar was never safe. Every generation that treated Ida safe eventually learned otherwise through war, inflation, currency collapse, or simply the arithmetic of time. What the last 12,000 years of human financial behavior reveals is not a set of frulies. It is a single, repeated discovery made fresh by every civilization. That survey vedlong anata have a surplus. Still things decay. Moving things endure. Risk shared across many is survivable. Risk concentrated in one place, in one container, in one jar, is waiting for the season that comes without rain. The grain pit of the Levant and the index fund of the 21st century are the same gesture, 12,000 years apart. They were always going to invest. The only question, then and now, is whether the fare of motion is stronger than the knowledge that stillness is already low, SS.